Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook. But this show isn't all about me today. We have a special guest, a longtime friend of mine. Russell Rhoads is here, and he's going to be joining me. And we're going to have a great little discussion before the Fed meeting about expected moves, long straddles, what's the VIX doing. Might even ask him, how are they calculating that VIX, Russell? Because Russell has written a few books on the VIX index, not to mention a few other things. And I'd like to actually bring Russell in at this point in time. Russell, you there?
I am here. I'm totally raring to go for the next hour. And I love that we got, that I get to do something with you. I lived in your shadow for a while. I followed you at the Options Institute. There's all kinds of prep stuff, but I don't share everything in the prep because I want to get a genuine reaction out of you. Our common boss, one of his common criticisms was, Brian used to do this. And Brian, you're like an older brother that I lived in the shadow of that. So, until I met you and saw what a nice guy you were, I didn't like you at all.
So Russell and I worked at the Chicago Board Option Exchange, which is now called SIBO Global Markets. And we were in the education section of that building up on, it was the 5th floor?
We were on 4.
We're in 4, right above the trading floor.
Yeah, 5 was a cubicle farm, and 7 was where, how many times they let you go up on 7? That's where all the leadership
was. Where all the magic
knows what
happened.
I'm saying, and that was where all the leadership was. I think it was 3 years before I went to 7 once.
Right, and we got to work with our good friend who's written quite a few books himself, Jim Bittman, which I know both Russell and I have a lot of admiration for. I'm going to actually come on up. By the way, I'm going to be up there in November, so I plan on stopping on by, and hopefully I and Jim and Shelly Natenberg will probably be around and see if we can get together and have a little chat.
That would be awesome. It's been too long with some of those guys post of the COVID thing.
I think what would be really fun is we should make that the podcast. Maybe I should bring my iPhone. I'll talk to our producers and see if we can stream that live, and that'll be the podcast for the day. I think that would be just a lot of fun. Right?
Are we gonna put a delay on it? Because some of the people at the table that you just mentioned, there's not much of a filter there.
That is true. That is true, especially in this day and age. As we get a little older, the filter kind of wanes a little bit.
Yeah,
I agree with that statement. All right, Russell. Well, let's get into it. And you said we're going to go an hour. That's fine. You can keep going, but the podcast is done in a half hour.
Well, I did not know that. All right, let's get to it.
Right. All right. So, but if you keep going, we'll just let you go. I got a place to go after this, but if you want to keep talking, we'll give you the stage. We're always up for that. 2 thumbs up.
Fantastic.
All right. So SPX is up 8, and the VIX disappointingly finished settled this expiration just below 14. So I've talked a lot on Options Guy TV here recently about the seasonality of the VIX and how it seems to start on August 1st and then gradually climbs into September and October. And then once we get into the happy period of our lives, all the holidays and all the presents and everything, we usually see the VIX come back down. And I've showed that chart before here on Options Guy TV. And over basically, I think since the VIX the VIX has been recalculated. Do you remember the year that they started recalculating it?
Oh, goodness gracious. Sometime in the middle of the last decade.
Okay.
So it's been some time.
It has been some time. So they've been that was what the chart was actually following ever since they recalculated the VIX. And it's been markedly higher. And so I actually did a couple of VIX trades, paper trades here on the show. And this most recent one, it didn't work out, but we didn't really lose our shirts on it because of the way that we set up the trade, Russell. So I kind of want to just talk about that to start and then get some of your ideas on what you'd like to look at in the VIX. And also, we have this big little meeting today by the Fed, and it's highly anticipated that they're not going to be raising interest rates. But I still think there's a 40% chance out in November that they might have a quarter of a point hike. Now, I'm getting those numbers from the Chicago Mercantile Exchange, the Fed Watch tool that they have. So on the VIX index, which I don't want to pull up my screen just yet, but I'm going to go there and get a quote on it. What we look to do is I think we sold the 14, bought the 12, and used the profits to buy the 17. And I did the SEP 20 expiration. And part of the reason why I really wanted to go out further in time, but I don't really like the volume in the weeklies. That's kind of an issue. So I would have liked to gone to like the 27th because of the major news event. And then also another major news event that we have coming up is we're going to have budget talks by the government. Those are always a lot of fun. So the end of the a budget is on the 30th, and October 1st is going to be a new budget. So it's not as risky as the debt ceiling, because the debt ceiling just shuts down the government. But when there's budget talks between Democrats and Republicans, the biggest concern is that areas of the government could get shut down. So that's a little bit nerve-wracking. And that's part of the reason why I'm kind of surprised that the VIX is where the VIX is to me, that's a lot more scary than this Fed meeting that's coming up. And I guess I'd like to get a little bit of your insights on why the VIX is where it is. Well, actual volatility, right? Actual volatility. The market doesn't seem to move anywhere right now. 44.50. Gosh, I was going to say, I didn't even have to look at the quote. I was going to guess that it was at 44.50 in the SPX. And right now it's 44.52.
So, the issue is, and we saw this in 2009 to a different extent, where the stock, everybody came into 2009 very nervous, and we bottomed out in March, and then worked our way higher. And VIX did nothing but trend lower. It was in the 20s, but it did nothing but trend lower. And it trended lower as there was what I like to think of as exhaustion behind hedging with S&P 500 puts. And, we talk about the VIX, but you got to remember the driver, and this, is S&P 500 index option trading. And if you've hedged a few times and it's basically cost you performance over the course of this year, you're going to be less aggressive with your hedging. And I think that's, even though we got a whole lot of landmines in front of us, and you mentioned a couple, one that I think a lot of people are not paying attention to is, and I'm one of these people because I have a student loan debt from a recent degree, people got to start paying their student loans. And, if I were 30 and I had to start making the payment I'm making, I'd probably be looking for a roommate or something to supplement my income. So I think that's another fourth quarter thing that is hanging over us, along with a lot of the geopolitical stuff. I just feel like when I see VIX at a level that I don't agree with, some people will say it's wrong. Well, that's fine. When something's wrong in the market, that's great. That's when you have an opportunity to do a trade. And the trade you did, although it didn't work out, that is actually my favorite long VIX trade.
All right. Yeah. And let me just reemphasize what I was attending, or what I was attempting to do. And then I'll let you come back and talk a little bit more about where you're going with the VIX and things. But what we did was this expiration, the September 20th expiration, which they stopped trading yesterday, and the settlement comes out in the morning. And the Fed meeting is, like I said, it's going to be 2:00 Eastern time today, where they're going to come out and announce their non-raise, which if they don't come out and decide not to raise the Fed funds rate, the markets will obviously, the VIX won't be at 14 anymore. But so what we did is you actually sell a put spread on the downside, thinking the markets can't, on the VIX, that they can't go lower, is really what you're saying. It's going to either stay where it's at or can't go lower. And you bring in a decent credit in the VIX because there's so much volatility. Because what's the volatility of the options inside the volatility index? Well, we know that answer nowadays because we got the VVIX, which will actually tell us that. And once we sell that, I take those proceeds and go out and see how far out of the money I have to go to buy a call. And my goal is to get it done for next to nothing or even a small credit. But that does mean that you have some risk to the downside if it goes below 14, and we finished right at it at this expiration. Or if that's your main risk is from 14 down to 12. But on the upside, you got a chip in a chair. You're buying an
Yeah.
out of the money option. You get a good pop in volatility because the market gets surprised, and then you had that opportunity to just sell that call and to remain short the short put spread that you did to pay for it. So there you go. And I love the fact that you said that's one of your favorite trades. As a matter of fact, we named Russell, and I do know you recall this, but inside the playbook, there's a strategy that didn't have a name that a lot of people do, basically the leverage covered call, and we called it the fig leaf. And I see that via Google, if Google is my gauge, that name is kind of taken off. Maybe this is your strategy. Maybe you're the VIX guy. Like you maybe should coin the strategy, because I've never heard of, a name for the sell a put spread to pay for a call, which that's kind of a long name. I don't think we could use that.
I've heard it called a put spread collar, I think, which I don't understand how.
Yeah, that doesn't make any sense.
It doesn't make a whole lot of sense. But just one other thing with respect to that trade is your risk. I think that's a backtrack. When I was at SIBO, you really didn't overlap with VIX, but I did. So I get a lot of VIX questions.
Yeah.
And a lot of snarky questions too. And I get, why should I use VIX instead of SPX options? And the reason is, doing the trade that you just talked about in conjunction with a long stock market position, if your risk again is that VIX goes down, well, that means odds are VIX is going down because your stock portfolio is going up. So it's a good thing. It's a good diversifier. And I like it for that reason as well. I also like that you can generally put it on for a small credit, and typically, you might, if you're in the money on your short put, like that 14 put was 4 cents in the money at expiration, it's probably going to be offset by a long stock position. And when you see that a form of that trade, whether it's some people will do a put spread and buy the call, and some people will do the put spread, buy a call, and then sell a farther out of the money call, depending on where VIX is at the time. And when you see that trade, typically it's going to lose money when the S&P 500 goes up an awful lot. And I've done some studies in the past where I look at taking 2% of your S&P 500 portfolio and doing this 12 times over the course of the year, and to help diversify you a little bit, and doing it both ways, where you do the call spread, bull call spread and bull put spread, or just the put spread and long call. And in fact, just to be a little bit shameless here, and we are going to look at my Substack, back in December of last year, early December, I got a question. And the question basically was, if I think we're going to get a volatility spike in the next 6 months, how would you trade it? And I said, I would roll the trade that you just talked about. And I did it. I paper traded it. And I think it ended up losing about 3 or 4 points or something like that, because it did not work. But it wasn't a complete disaster of a hedge. And again, if you had combined it with long stocks, you would have you still would have done okay, because the stock market did very well. My out on it was if VIX got above 30, and VIX did get above 30 in March, but I stuck with reality because it happened so quickly. There was no way I would have traded out of it in the real world.
Right.
So there are people out there that say, well, see, it ran up there and I would have gotten out. For liquidity purposes, I'm certain I wouldn't have been able to get out of that trade.
Right. Yeah. Right. And I loved everything that you just said there. As I've never really, I've more thought of that trade. And once again, you got to come up with a name, because we keep calling it the trade.
Yeah.
Maybe we call it the Russell, but then there's an index named after you. Oh my gosh. I mean, there's just so many things. But with that said, that trade, I always had thought of that as a speculation trade. But then again, I totally buy your scenario here about the fact that you're getting, so if you want protection on your portfolio of stocks that, let's say, matches the S&P 500 index, you would buy call options. Well, in the VIX, call options are very expensive. And one of the hardest things to do about just buying a call option, as Russell said, the VIX spikes up to 30, and all of a sudden the markets just kind of die down and people forget about why the VIX spiked to 30. And before you know it, it's at 20. So if you're just buying a call option outright to try to protect your portfolio, it's really hard to gauge when you should get out.
Mhm.
Like 2008 was a great example there. I got to admit that I struggled in 2008 because the VIX just stayed around 35, 40 forever. It just didn't
Yeah.
seem like it would mean revert. And that was just very odd. But that would have been a real tough year to try to guess when you want to get out of your call up. You've been happy that you had them,
Mhm.
but trying to figure out when to sell them and just remain long the stock in your portfolio would have been really rough.
Oh,
So
yeah.
by doing this trade, I just you got more flexibility
Mhm.
because it's being paid for.
And beyond that,
Yeah.
and this is something you remember Bill Speth,
Yes, of course.
who was,
Mhm.
for people who don't know the name, he was head of research at SIBO and one of the smartest people out there in our business. He pointed out the fact that VIX options, we deal with time decay and all that.
Yeah.
VIX options, because of that possibility of a spike, they actually hold their value really well up until at minimum the Friday before expiration. And I tend to switch my front month from, like last Friday, I went to October.
All
So
right.
I would have rolled the trade to October. But VIX options tend to hold their value very well. And if a trade doesn't work out, you generally can salvage it, if you've got a long option trade in there.
Okay, so I want to go all the way back to my initial conversation when I introduced the Russell VIX trade. So to go all the way back to that, one of the things that I've struggled with is the weeklies. The
Mhm.
symbol, if you look on the Trade Hawk options grid, is you'll see a VIXW, and the W implies that. What are your thoughts on trading the weeklies in the VIX as opposed to the normal monthly expiration?
It's a liquidity issue. Now, I would do one type of trade and not another type of trade.
Okay.
I would be more than I would if I were gonna let's I'm just looking at those options right now. The
Yeah. Feel
options
free
that
to pull
expire
up the
next week.
change because I actually looked at that trade here on Options Guide TV, and then I realized what I did, and I came back and I had egg on my face and said, honestly, I wouldn't have traded these. The markets were just a little bit too wide.
Mhm.
I would have done the monthlies if it wasn't a paper trade. So I'm calling myself out here
Oh,
on
well.
that trade. But yeah, so looking at the VIXWs, what are your thoughts?
Well, right now, and this is an unusual day because FOMC is coming up a little later.
Right.
But
That's true.
on the call side, the September 27th have traded about 10,000 contracts or so. The spread's pretty wide, like 15, 18, 12 cents. If I were going to trade the weeklies, I would do something that I totally expected to hold through expiration. So let's say I felt like it was going to stay under 15 between now and next Wednesday. Do a call spread where I short the 15 call and buy something else. If I'm going to do a trade where I need to monetize it, and that really, when you have a long VIX trade, you really do need to plan on monetizing it. Like I said, VIX over 30, I'm getting out of that
Right.
that spread. I don't mind trading these options again if I intend on holding them to expiration, because I don't have to worry about that lack of liquidity to get out of the trade. But also, when the market's more volatile, the liquidity tends to get even worse. I don't have a good numerical example, and I'm just talking from experience and not here's an example of a terrible exit. But I would use the monthlies in the way that you talked about. I'd use the weeklies if I was planning on doing something that I was going to hold through expiration.
Right. And part of that reason is then you don't have to deal with the bid-ask spreads on the way out. And it gives you, because you get that flexibility. It's okay to work a trade to get in, but it really sucks when you have to get out.
Yeah, no, absolutely.
And that's the issue with liquidity. So, because if you get your price, you get your price. You toss it out there, and if somebody takes the other side,
and
you're good. And
on the other side of that, part of what I do every week when I look back at the market is I do look at block trades, and I'll look at the 20 biggest block trades. And like right now, the 20 biggest block trades, one of them is a VIX weekly. So institutions are getting things done, but it's a VIX weekly. It's the 31 call. So odds are they were selling it and they're holding it to expiration.
Yeah, you're probably right. You probably, yep. So we're going to go a little bit long, but I want to take a little bit of a break and let everybody know that if you have any questions for myself and Russell, please feel free to put them in the chat box and we'll try to address them on the show. But we do probably need an hour today to get through everything that we want to get through. But at this point in time, Russell said he wants to show us his Substack. It made me a little nervous, but then I realized that that's his newsletter that he sends out, and I get it. I get it in my inbox usually at the beginning of the week, right? Isn't it like every Monday or something?
I put a review out on Saturday, and
I see it on Monday,
and I put a preview on Sunday, which is for Monday morning is probably more important.
All right. I want to go through some of these numbers because I find this to be a very, well, just because of the math geek that's in me. Russell puts out some numbers that shows you, like, going into a Fed meeting, how much the market has actually moved and what the long straddles have been priced at, which is basically effectively the expected move of the marketplace going into a major news event. And we talk about that a lot here on Options Guy TV around earnings. And when we look at speculative strategies based off of, the Magnificent Seven around earnings, we do a lot of those type of things. So, Russell, I'd like to bring that up and actually kind of show what we have here and talk a little bit about what we're seeing.
Sure. So this, I'm going to go to the bottom of the Substack, and I'll go back up to the top in a second. But what I do is since we've had daily index options on the S&P 500 and the NASDAQ 100, I've tracked 1, 2, 3, 4, and 5 day at the money straddles and seen how often they're overpriced, how often they're underpriced. And then I also have tracked them around significant economic events like FOMC, CPI, which is becoming a complete non-event, and the employment number and a few other, and then NASDAQ around some of the big NASDAQ earnings as well. So what I'm showing you is the just the price change, that with the 1 day price change off the FOMC for the next, for the last 12 moves. And it's like a funnel. Look, I mean, they've become less and less and less, less dramatic. And in fact, if I go even farther back, there's some bigger bars on it.
So working left to right, I think if you put your cursor on, we can see it. Yeah, so you can see the potential moves, but that's when recession talks were around.
Yeah,
right.
And now, I mean, look at the last 2 FOMC days.
Yeah,
that's ridiculous. And
right now, it looks like we're going to keep that trend going.
It's acting like it. And what I also do, and something you mentioned, is I track the at the money straddle. And long term, I track the at the money straddle as a percentage of S&P 500. But for events like this, I'll show what the straddle was at, and I'm using the midpoint pricing. I show what the straddle was at, and then what it settled at. So if I were showing today's, I would have shown the at the money straddle on the close last night, and then I would figure out what that straddle is worth on the close today. And you can see it was $53 back in June, and it was $259 on the close, and it was 34
so the $53, just so that I can explain it for our listeners out there. So that blue candle is saying that's what you would have paid for it at the beginning.
Exactly.
Right. And the night before, tiny light blue calendar, the little dinky one there, that's what it was worth afterwards.
Exactly.
So what would we have wanted to do if we would have known that previously? What would have been the strategy we would have used?
We'd have sold a straddle.
Yeah, we would have sold a straddle, or even an iron condor is probably more common, right?
Well, I was getting ready to say we would have sold a straddle if we knew for certain.
Yeah.
All I want is tomorrow's Wall Street Journal once in my life.
Just one.
But
it's not like you're asking for the whole world. You just
once. You know, there was a TV show where the guy got the next day's paper. I'm like, look at the lottery. But what I'll do is I mentioned that percentage, and when I trade it, I'll take the at the money straddle, what it's pricing in for the move, and I'll use that to choose the strikes on an iron condor, because I don't want to be short a straddle, back in on the left side of this chart. So that's what I'll actually use that percentage to choose the strikes on an iron condor. and it will just kind of dictate what the market's thinking. And if I think there's going to be a smaller movement when the market's thinking, that's how I would go about trading that, because I don't want to be able to sell options naked. I've never asked for the permission to do that. Just to make sure that I don't do it by accident.
Right. You want to lay down until the urge goes away. So if you never ask permission, you don't have to worry about the urge.
Yeah. One thing I want to point out about this straddle pricing right here, this 34.55, that's about, I think about 0.65% of the S&P 500 at that time. That's right in line with the average one-day straddle in 2023. So you haven't even seen elevated straddle pricing into the FOMC anymore.
So right now we should be looking at that SPX straddle, right? Yeah. So if we were going to look at, you got your chart all together, but we got a couple more hours. We got a meeting.
Yeah.
So is that when you would take the pricing before the 2 o'clock, or do you take it on the open or on the close? When is that pricing?
I do it the night before. So this is a one-day straddle. This is based on the previous day's closing prices.
Okay.
Part of it's just the data. A lot of people have asked, well, why don't you look at the open? Well, it's a data thing, to be honest with you.
Yeah.
Putting this together is hard enough with going through and pulling the at-the-money straddles for all these expirations. I finally, and this sounds like I'm humble bragging, I finally broke down and bought myself a Bloomberg, because instead of it taking a whole weekend to do some of these things, it now takes me just a couple of hours. I was like, if I'm going to keep trying to do things like this, I've got to have access to better data. So I am in the process of working with a couple of students. And we didn't mention I teach at Indiana, but I'm working with a couple of students that are helping me compile the open to the close for straddles and other numbers as well to get a little bit more specific. I personally would love to price the at-the-money straddle at noon every day and then look on the close. And something else that I'd really like to look at is I've had a lot of success without any back testing of sell-in volatility for the options that expire the next day, like in the middle of the day, and covering them on the close. Like when people start to turn to the next day, I've just seen this. I've seen something.
Okay, you're selling what are we selling options in?
I'll either put an iron condor or a put spread or a call spread, and
on the SPX or the SPY?
SPX or SPX or NDX, depending
NDX,
on
I gotcha.
Which market I'm bullish or bearish on. And take that thing off on the close, or maybe even on the next day's open. And I've had a lot of success with that. And one of the reasons I've been looking at the second, third, fourth, and fifth days is I got to meet this guy named Ed Thorpe once, who invented card counting, basically. And I got you when you have an interview and it's a guy like that, you say, so what are you looking at right now? And he said, I'm always looking where other people aren't. So with these short dated options, I'm looking a couple of days out instead of the one day, and just seeing if I can find some mispricings there.
Interesting. All right. So we're coming to the end, but I think we'll go a little bit longer, because I do know that I want to ask you, what is your most exciting trade you got going on right now?
Right now, I was short the S&P 500 for a while, and it was based on two signals. One was that VIX hadn't made a new low, and then it did. So I got out of my short position in S&P 500. But the way that I did it is a little unusual. I'm short the S&P 500 with futures, with the micro futures, because it's easy to do an equal balance with long my favorite index, the Russell 2000. And that's because year to date, the last I checked, the Russell 2000 had underperformed by about a little over 10%. And when that happens in the first 3 quarters of the year, that gap has almost always narrowed. There's been one time it hasn't, but the one time that it didn't, it just widened out by a couple of more percentage points. So it wasn't that bad. And I use the micros because it's easier to get a 1-to-1 balance.
Okay.
If you got to multiply about 2.5 times the Russell 2000 to get the S&P 500. So with the micros, I would short 2 S&Ps and buy 5 of the Russell 2000s.
All right.
Doing that balance with big contracts gets to be a big dollar amount and ends up taking up too much of my account as well.
Right. And you can execute it at the same time. So you got market movement risk when you're doing those too, right?
Absolutely. Yeah. They're very liquid markets, but yeah, they're
okay. So that's not that big of a concern.
No, I'm not worried about execution risk on that one.
Okay.
Sure.
So with that said, obviously we don't trade a lot of those products here at Tradier, but do you have anything that you look at that might be a little bit more in options guy territory?
Oh, most definitely. And I'm a big proponent of being short volatility over a long period of time.
Okay.
And I've been around long enough to know that I'm going to get my rear end handed to me every once in a while when I have a position like that on.
Okay.
And I think the best
prepared for that. Yep.
Yeah. And I think the best, the SVIX, which is a relatively new ETF, it kind of took over for the ETFs that got damaged or went away back in the Volmageddon thing.
Yeah.
So, but
they just disappeared.
Yep, pretty much.
So that's the short VIX futures ETF.
Exactly, and that thing is up. Goodness gracious.
Yeah, it is. Well, it's not up a ton. It's up.
This year. Where's my year?
Oh, you're looking at the year. Okay.
Yeah, year to date, that thing is up. It's about a double. Yeah. So it's up from about 15 to well over 30. So I always have a position in that. I scale up and down with it. And then I also sell calls against it. And right now, if you were to buy that thing at, it's around 30, it's at about 32 and a half. If you paid 32 and a half for it, you can go out to the January options, the call options, and you can sell the 33s for about $4.50. Which, divide 450 by 3250. What are you looking at? Like a 15%, 15% of the cost of the SVIX.
Right.
I'm fine making that, but if we have a volatility event, which would be detrimental to SVIX, I might cover that option, and then when SVIX recovers, which it always does in time, sell another call option against it.
Right. So you just need to make sure that major event doesn't happen on the expiration of the option. Right. If you can prevent that, then you're pretty safe. Is what you're saying. Because if it happens a week before, the market might tame down by the time it gets to the expiration.
Yeah.
But do you usually then close it out?
Sometimes I'll let it, in this case here, if SVIX is up, if it's 3-4 points in the money, I might let it be called away.
Okay.
Like I said, I scale up and down, and right now I'm 100% of what I would normally have in SVIX, but 50% of it I've written those options against. So if it got called away, it would be called away because it was, it was well ahead of itself. And I would.
We don't mind it getting called away. So
I don't mind it being
risk
called away.
Exactly. I got to think the opposite way, right?
Yeah. Yeah.
So if the market spikes, SVX tanks.
Exactly. So if the market tanks and SVIX spikes up an awful lot and it gets called away from me,
you're okay.
Yeah, I'm okay with that because I'll look for an opportunity to get back into it. I'm not having all of it called away as well. So I'm always scaling around a short volatility position, using that ETF and using the calls on that ETF.
Well, that's very interesting. Okay, so I'm going to give one last opportunity here. If there's any comments or any questions that you may have, throw them in the chat box. And if not, we just jumped right into the show, Russell. You mentioned your student loans. That's because you have how many PhDs nowadays?
I have. I'm an old student. I completed my PhD with a focus in behavioral finance about 2.5 years ago. Yeah, coming up on 3 years ago now. And I teach at the Kelley School of Business at Indiana now. That's kind of my full-time job. And then I write the Substack and really just talk about the markets to keep me sharp on the markets and do some consulting work as well.
Well, I hope we get an opportunity to come back and do this again. If they're interested in your newsletter / Substack, where do you have a short URL that they can go to? Or
it's not terribly short, but it's my full name, russellrhoads.substack.com.
All right, russellrhoads.substack.com. All right. At this point in time, I don't see any other questions, Russell, and we are at time a little bit long. We went a little bit long today, but kind of fun. We got the VIX, we got the Fed meeting coming up, and what do we think? Market going to be up or down before the end of the day? So we can both make a guesstimate on that, and we'll leave it there.
I think it's got, I put on an iron condor thinking that we weren't going to get much of a move. So I'm kind of thinking another dud of a move.
All right. So at the show, I was watching the SPX and it literally stopped right at 44.50. So that's going to be my number. I saw it during the show. It literally traded right there. Exactly. So our forecast today is that the market's not going anywhere.
Not going anywhere. Yeah.
Not going anywhere. All right, Russell. Well, this was great. I do appreciate it. Please click subscribe, ring the bell, pound that thumbs up, and we'll be back this coming up Friday to see what the Fed has done on Options Guide TV, 11 o'clock Eastern time. Thanks for coming, everyone.